When traders open their charts and see red everywhere, something very powerful happens inside the mind. The screen becomes emotional. Prices are falling, candles are red, indexes are dropping, news headlines are negative, and suddenly the market no longer feels like numbers and charts. It feels personal. Many traders know this feeling very well. You open your platform, you check the markets, and almost every chart is red. Stocks are falling, crypto is dropping, indices are declining, even trades that looked strong yesterday suddenly look weak. And in that moment, the mind begins reacting. Questions appear quickly. Should I exit my trade? Is this the beginning of a crash? Should I sell everything? Am I about to lose money? When every chart is red, the biggest challenge for traders is not analysis, it is emotional control. In this video, I want to talk about something that every trader must learn: how to stay calm when every chart is red. Because when markets fall, emotions rise. Fear increases. Stress increases, and decision-making becomes harder. But if you understand the psychology behind these moments, you can stay calm while others panic. If you stay with me until the end of this video, you will learn why red markets trigger emotional reactions, how professional traders manage these situations, and what mental habits help traders remain stable during market declines. And if you want to build strong trading psychology and emotional discipline, consider subscribing to Bull Mindset. This channel focuses on the mindset, discipline, and psychological frameworks that help traders survive and succeed in financial markets. Now let us begin with something important. Red markets are normal. Markets do not move upward forever. They move in cycles. There are bullish periods, there are neutral periods, and there are bearish periods. This cycle is part of every financial market. But the human mind struggles with declining prices. When markets rise, traders feel comfortable. Green candles create confidence. Profit creates optimism. But when markets turn red, psychology changes quickly. Losses appear. Positions look weaker, and uncertainty grows. The brain begins interpreting the situation as danger. This reaction is not random. It is biological. The human brain is designed to detect threats. When something appears risky, the brain activates a survival response. In financial markets, falling prices can trigger this response. The brain begins thinking in terms of protection. Protect capital, avoid loss, escape risk. This is why traders often feel an urgent desire to act when markets fall. They want to close positions quickly. They want to stop the emotional discomfort. But reacting emotionally during red markets can create bigger problems. Let us talk about why. When traders panic sell, they are not following their strategy. They are following fear. Fear pushes traders to exit trades too early. Fear pushes traders to abandon their plan. Fear pushes traders to make decisions based on emotion instead of analysis. And when fear controls decisions, consistency disappears. Now, let us talk about another emotional reaction: overreaction. When every chart is red, traders often assume the worst. They imagine that markets will continue falling endlessly. They begin predicting catastrophic scenarios. But markets rarely move in straight lines forever. Even strong downtrends include temporary recoveries. Professional traders understand this. They do not assume that red candles mean permanent collapse. Instead, they observe market behavior calmly. Now let us talk about the mindset difference between emotional traders and disciplined traders. Emotional traders react immediately. They open charts, they see red, and they begin making decisions quickly. Disciplined traders do something different. They pause, they observe, they evaluate the situation, they ask questions before acting. What is causing this movement? Is this temporary volatility? Is this part of a larger trend? What does my trading plan say? This pause creates clarity, and clarity reduces emotional decisions. Now let us talk about the role of uncertainty. Red markets often appear during uncertain events: economic data, interest rate changes, geopolitical conflict, unexpected global news. During these moments, investors do not know what will happen next, and uncertainty increases emotional pressure. The mind wants certainty, but markets do not always provide it. Professional traders accept this reality. They understand that uncertainty is part of trading. Instead of fighting uncertainty, they manage risk. Now let us move into real trading examples. Imagine a trader holding a position during a market decline. The chart turns red. The position becomes negative. The trader begins feeling uncomfortable. The mind says, "Close the trade immediately." But the trader checks their strategy. The stop-loss level has not been reached. The trade setup is still valid. Instead of reacting emotionally, the trader follows the plan. Sometimes the market recovers. Sometimes the trade eventually stops out. But the key point is discipline. Now imagine another trader in the same situation. They see red candles. Fear appears instantly. They close the trade quickly. Later, the market recovers and moves in the original direction. The trader realizes they exited too early. This experience creates frustration, and frustration often leads to revenge trading. This cycle damages consistency. Now let us talk about another scenario. A trader opens the platform in the morning and sees red across multiple markets. Instead of analyzing carefully, the trader assumes the market will continue falling. They open aggressive short positions, but suddenly the market rebounds. Losses appear quickly. This situation happens often because emotional predictions are not reliable. Professional traders avoid making impulsive assumptions. They analyze the structure of the market rather than reacting to color on the screen. Now let us talk about mental frameworks that help traders stay calm during red markets. The first framework is acceptance. Red markets are part of market behavior. They are not abnormal. They are not unexpected. Accepting this reality reduces emotional resistance. When traders stop fighting market conditions mentally, they become calmer. The second framework is probability thinking. Every trading strategy includes losing trades. Market declines may increase the number of losing trades temporarily, but professional traders evaluate performance over many trades. They do not judge themselves based on one moment of red candles. The third framework is risk awareness. Professional traders always define their risk before entering a trade. Because risk is defined in advance, they do not panic when price moves against them. They already know the maximum loss they are willing to accept. Now let us talk about practical exercises that help traders remain calm. One simple exercise is controlled breathing. When markets fall quickly, the body reacts with tension. Breathing becomes shallow. Heart rate increases. This physical response increases emotional stress. Slow breathing helps calm the nervous system. Taking 5 slow breaths before making a decision can restore clarity. Another helpful exercise is stepping away from the screen. When traders stare at falling prices continuously, emotions intensify. Taking a short break can reset the mind. Professional traders understand the value of psychological distance. Now let us talk about long-term perspective. Markets have experienced many declines throughout history: financial crises, economic recessions, global conflicts, pandemics. Yet markets continue functioning. Prices fall, prices recover, cycles repeat. Traders who maintain long-term thinking remain calmer during temporary declines. They understand that one red day does not define the entire market. If this video is helping you understand how to manage your emotions during red markets, consider subscribing to Bull Mindset, because developing strong trading psychology is one of the most valuable skills a trader can build. Now let us move toward the final message: control. Traders cannot control market direction. They cannot control economic events. They cannot control global uncertainty, but they can control their reaction. They can control their discipline. They can control their risk, and they can control their mindset. This is the difference between traders who survive market declines and traders who panic during them. Let me leave you with one final thought. When every chart is red, it feels like the market is dangerous. But the real danger is emotional decision-making. Fear can push traders to exit too early. Frustration can push traders to revenge trade. Panic can push traders to abandon their strategy. But calm thinking changes everything. When traders stay calm, they observe the market clearly. They follow their plan. They manage risk carefully, and they allow probability to work over time. Red markets test psychology, but disciplined traders pass that test. Stay patient, stay disciplined, and remember that the strongest traders are not the ones who avoid red markets. They are the ones who remain calm during them. And if you want to continue strengthening your trading mindset, subscribe to Bull Mindset. I will see you in the next video.